homebuyer.com. Status connected. Facebook live connected. Rumble connected. Twitter X connected. LinkedIn connected. This is the booth. We are cleared to go live. Send the signal to the studio and go live.
List with Elizabeth show, ready to go live in 3, 2.
When you think selling and buying a home,
When I think real estate, I think List with Elizabeth.
Elizabeth Kline.
Elizabeth Ann Kline. And here is the host of the List with Elizabeth show, Elizabeth Kline.
Hello, hello. Hello, everybody. Welcome back to the List with Elizabeth show. I am Elizabeth Ann Kline. I work with buyers and sellers in the Northern Virginia area and beyond who want to buy or sell residential real estate, homes, investment properties, townhomes, condos. That's what I do day in and day out. And there's a lot of moving parts with this process, whether you're a buyer or a seller. So tune into our show to get tips on both the buying and the selling process. Thank you so much, everyone, for all the comments, all the likes, shares, and subscribes that we have had up to this point. And if you haven't done so already, I do encourage you. There's my little superwoman there. Please come on in and subscribe to our show today so you don't miss any of the latest content. Share this with some friends. Comment below. Give me a call, 703-829-LIST. If you have questions, you want to chat, I am so happy to help. Today, we're going to be talking about a topic that actually affects both buyers and sellers. And our topic today is going to be understanding mortgage rates. Mortgage rates are actually something that will affect you as a buyer and can also affect you as a seller. I am going to bring in one of my trusted local lenders. I am the realtor. Lee is the lender. And Lee Williams, he is with Embrace Home Loans. And he's going to join us today so we can talk a little bit about mortgage rates. Hi, Lee. How are you?
Hello, Elizabeth. Hey, appreciate having me back.
No problem. Sorry, my voice is a little. I'm going to let you do more of the talking today. But Lee, thanks so much for coming back. If you want to tell everyone a little bit about you, and I'll let you take it from there.
You got it. Hello. Well, thanks again. Like I said, thanks for having me back, Elizabeth. Lee Williams with Embrace Home Loans. I'm here serving kind of the Northern Virginia, D.C. marketplace. And I've been doing this for, I don't want to date myself too much, but I think about 22 years right now. And really excited, very passionate about the market that we're going into over the next couple of years. And love to share some insights that collaborating with other loan officers in the area and following the news and follow what is going on. Look forward to sharing that with you today.
Okay, great. Thank you so much. So, and again, I just want to say that mortgage rates are something that sometimes a lot of people don't understand how they work. What are they? So we're going to really just start at the beginning. And if we can bring up our first slide here. The beginning is, what is a mortgage rate and how is it determined? So Lee, tell us a little bit about that.
I can kind of take it from here. I'm thinking through what I'm looking for. I'm enjoying talking about mortgage rates again, because for the last 2 years, we have seen interest rates rise significantly. And all I've heard in the industry is margin compression from my loan officers. That's basically of liquidity for loans, and then for Barry Babib, I think tagged it as marry the house and date the rate. So hopefully what we can discover through this is we might not be dating as much going forward. But simply put, a mortgage rate is the interest charged for a home loan. Mortgage rates, can either be a fixed interest rate. Typically, you'll see that on a 30-year term, 20-year, 15, even down to 10. They can also be variable. You hear that in ARMs on 3, 5, 7, and 10-year ARMs. And, they fluctuate sometimes with a benchmark interest rate. Basically, interest rates you can keep an eye on the 10-year Treasury bond to measure those. But that's kind of what the interest rate is. It's really the amount that you pay. Borrowers see this. They might not be aware of it, but they see this on the truth in lending disclosure for a mortgage. So it shows you borrowing a certain amount of money, and over 30 years you pay that amount of money back plus the interest. So let's just, on a $500,000 loan, you actually can see that, especially in the amortization table, how much interest plus principal you're paying over the life of the loan to pay that down to zero. And I know with most of our closings, those people are kind of taken back when they see that large amount of money of interest. So really, rates are kind of determined by market factors like inflation, the cost of borrowing money, bond yields, that's like the 10-year Treasury, and the risk involved. And then there's also personal factors, financial factors, jobs, income, down payment, how much people have saved up, whether they can put down 5%, 10%, 15, 20, 25. All of these play roles in determining an interest rate, along with credit history, which is very important.
So I definitely want to just take a moment to pause on that, because so many times buyers will contact me and say, "Hey, I'd like to buy a house. What are the interest rates?" And just like you said, Lee, there's really not a straight answer to that, because it does have an influence. How much income do you make? Well, what do you have to put down? Where's the money coming from? What's your credit score? So when people are, let me ask you this.
Yeah.
When people are sitting at home, Googling like, "Hey, I want to buy a house. What's the interest rate?" And they type that into their computer and bam, a rate pops up, right? There's a rate.
Right.
They want to know, like, can I get that rate? Or can I get that rate lower? Or will that rate be higher? How much does the personal factors weigh into that rate? And what are they seeing when Google spits out, right, that rate? Is it usually the 30-year? Like, what are people usually seeing?
Great question. I think to really sum it up is it's a educational process, because you're absolutely right. Somebody comes to me and they say, "What is the 30-year fixed rate?" And I've Googled it on the computer, and here it is. And I'm going, okay, well, let's dive deeper into that. What really helps me is understanding them as a person, as a couple, to find out those factors of job, what type of income do they have? What are they looking for? Sales price? What is the monthly payment that they're looking for with a down payment? Not to mention the credit score. So many times advertisements color me shocked. They're throwing in, discount points, origination points. Yeah. I mean, we all tend to get the money from the same place. It's all through treasury bonds and mortgage-backed securities on Wall Street. So there's really not, there's not a major fluctuation. So when I see somebody come in with a really low interest rate that I think is a little bit off the, let's say, the national average, first question I go is, okay, well, are we putting down 20%? Or let's look at the cost factors in that loan. What are they advertising? Oh, so there's a discount point, there's origination fee. And what that really does is it promotes a educational process to bring the borrower in to provide them the information they need to make the best short-term and long-term financial decision.
Right.
Especially in a rate environments when rates were going up, but even more importantly, when rates are going down.
And what Lee's talking about is when a buyer comes to him and presents him with an advertised rate, right? Not necessarily that they've already gotten a pre-approval or done a loan, but they say, hey, oh my gosh, I saw this ad and it's 5%. Can you get me 5%? And then Lee has to sit there and dissect and say, well, how is this lender getting to this 5%? It's assuming you make more money than you do. It's assuming you've better credit than you do. It's right. There's all these assumptions built in. It's all marketing. So buyers out there, I think the message is when you are ready to look for a house, you have to pump the brakes, slow down, and talk with a local lender that's going to be able to walk you through all the ins and outs, that everything that makes up an interest rate for you or mortgage rate for you.
I agree 100%. And it starts right there.
Right when you're about to start.
It does.
Perfect.
So anyway, I'd love to jump into also kind of, I guess, the policymakers and who's going to be making all these decisions for us in the near future that's going to direct us.
Yes. How does all this work? Give us the behind the scenes.
All right. So I'll kind of do a little summary here. So what we're going to talk about is a little bit the Federal Reserve Bank. And really, they control the Fed funds rate. And currently, the chairman of the Federal Reserve Bank is Jerome Powell. And you have other voting members of the committee, Board of Governors and heads of the Federal Reserve Banks. They make up the kind of the Federal Open Market Committee. Okay. What the Fed does is they have a dual mandate established by Congress. And that is two things: achieve maximum employment in the United States and stable pricing. Fed's policy is to kind of manage these financial conditions and achieve its goals. Policy decisions affect the financial lives of every American, every business, and every consumer down to the borrower looking to purchase a home. They really are provided several tools to do this as far as policy goes, as far as the Fed. Mandates include they can control the money supply, and very importantly, they can set targets for interest rate targets and adjust the interest rates on reserve balances that banks hold with the Federal Reserve Bank. We see that, and we see those corresponding to interest rates moving up and moving down according to their decisions and targets. Kind of their targets as far as inflation that we have seen, and we've heard about all on the news for the last 2-3 years. Annual inflation target is 2%. So their goal, and Chairman Powell has made it very specific, very interesting. They're going to get to 2%. Currently, we're at 2.89%. So the goal is to get that down to the 2%. Current inflation rate as of July 2024, I think, is 2.9%, which is down from 8 to 9% post-pandemic. So we've made quite a transition on their mandate to move inflation down to the 2% level. The federal funds rate, the Fed influences the federal rate by changing the interest rate it pays on reserve balances that banks hold at the Fed. So they can manipulate the interest rate, the Fed's funds rate, up and down, that corresponds to interest rates. So you see when Fed funds rate has been going up, your credit card balance, the interest rates go up in your credit cards, car loans get more expensive. mortgages get more expensive. The goal is to cool the economy to bring inflation down. And that's their tool by doing that. So pretty much expectations, I think, for the Fed is really actually, this is great. Thanks for bringing up the slide. The Fed funds rate over the last 10 years. So we can see that, for 22 years, I've been doing this, and I've relatively been in a low rate environment arena, I would say. The overall trajectory of interest rates have been fairly low. You can see in this graph right after the pandemic that the rising Fed funds rate rose from a 0.25% in March of 2022 to 5.5% in July of 2023. And the rate has remained steady since then. So that was the tool used to slow down the economy, bring inflation back down in line. The changing in interest rates by the Fed funds is a lagging indice. So they make a policy decision and they implement it, and it goes into it goes out into production or out into the environment. It takes 6 months, maybe sometimes 9 months for you actually to see these implements change. That's why even if interest rates or if inflation isn't down to 2% right now, it's trending down that line. So what they don't want to do is they don't want to keep interest rates higher or the Fed funds rate higher so that it goes down past the 2% mark. That's their mandate. And that kind of would send things into recession. So it's a fine balancing tool. So they have to do predictions. And they really have been measuring those predictions. The Fed has been monitoring over the last 2 years the data, which makes rate cut decisions possible, which we'll get to and what we're going to see here in the fourth quarter. They've been following primarily CPI, which is the Consumer Price Index, and the PCE, Personal Consumption Expenditures. Both measure falling or increasing inflation. So that's why those data points have been so important. And you've probably heard me talk with your clients. Okay, hey, CPI readings are coming out the second week of the month. Let's see what that is. Interest rates might drop a little bit, as they come, when we get a positive reading on that, meaning inflation moving down to the target of 2%. Now, with inflation moving down, the big talk that we've all been paying attention to is the labor market, jobless claims, because what they don't want to do, their other mandate is to stable pricing and maximum employment. If you have unemployment rising, all of a sudden you're defeating your purpose. So we need to have interest rates. It's time to start that walk down on the interest rate ladder. And they're expecting policymakers kind of fourth quarter expectations. We're likely to see 1 or 2 interest rate cuts in 2024. Most interest, this is important. The Federal Reserve Bank, or the committee, meets 3 more times this year. They're meeting September 18th, November 7th, and December 18th. At these meetings, that's when they can change and update policy. Right now, on the September 18th meeting, we're predicting a 25 basis point cut. So what that means is that's dropping the Fed funds rate down 25 basis points. That's not dropping mortgage interest rates down 25 basis points. Okay. That's the Fed funds rate. So there's two separate items. It will follow, but more importantly right now is that buyers need to understand that's the expectation, 25 rate cut right now in September. That's already being priced into loans as of right now.
That's what I was going to ask.
Yeah.
So these expectations affect the market before they actually happen. So, and the other thing I just want to note is any of you out there listening, you may be a little confused by everything that Lee's saying. It's a lot of information. There's so many moving parts. If you don't watch this every day or study this or, have a background in this, I want you to know you don't have to understand every single in and out. You need someone good like Lee guiding you through this. So again, I go back to when you're going to buy or sell a house, please align yourself with professionals. Someone like Lee who's going to say, okay, Mr. and Mrs. Buyer, you and Elizabeth just got under contract last night. Let me tell you what's going on in the financial arena and why I think we might want to lock your interest rate today, or why I think we need to wait in 3 days and see what this meeting holds or what that meeting holds. You have a lender that's not plugged into all of this and just says, oh, you went under contract. Okay, great. Here's your interest rate. We're going to lock today. You're definitely losing money, because there's so much fine tuning when it comes to the financial end of your purchase, that again, working with someone who understands all the ins and outs like Lee Williams is critical to your long-term payment and success.
I absolutely agree.
No, it's a lot.
Really structuring the loan, it all plays into a time frame when closing and stuff like that. So it right now with the interest rate cut expectation of 25%, now is a good time to be locking. The only thing that could change is if they take more, go to 50 basis points. But you know what? I don't have that crystal ball. But the trend though, of what we're seeing for fourth quarter is, first of all, the Fed's movement to actually start lowering the Fed funds rate. And that's what we've all been waiting for. And we need to see that continue. And that's, I'd love to see a total of a 75 basis point cut by the end of the year. But that might be a little wishful thinking. But people need to be lined up. It is possibility for refinances. Interest rates were extremely high. Last November, peaked again in it was May, June. So we are looking for refinance opportunities. And it's also we're in that transition time, Elizabeth, right now. On, the market slowed a little bit. Interest rates have been high. They've come down some. Home prices have stabled a little bit. It's a good time to go out and buy right now with less competition out there.
Absolutely. And, I just want to say that even when interest rates were in the 7s, people bought houses and they're just going to refinance now, right? They're going to refinance when the rate's coming down, when it makes sense for them. So you cannot time the market. When the time to buy is when it makes sense for you and your family, for your circumstances, for your job, for your children, that's when it's time to buy. The rate is going to go up, it's going to go down, it's going to do what it's going to do. And when it goes lower than it is when you bought, you look at a refinance. That's it. So don't get yourself so tied into, trying to grab the interest rate right out of the gate, because the situation, the timing may not be right for you at that time. And the houses that are available in those exact moments may not be ones you really love. So do what's right for you and your family. Put the rate to the side. Work with someone like Lee who's going to educate you, explain everything, and make sure that in the next 24 to 48 months or so, you're locking into the best rate that's possibly there for you.
Absolutely. I would like to move. Let's get out the crystal ball.
Okay.
And look at some future predictions here.
Right.
And
perfect.
So what I wanted to do is I wanted to pull up. I did not put these numbers together, first of all. So I've not quite have the PhD to do that. But this is the Mortgage Bankers Association, their finance forecast. And it really goes from 2023 through 2026. I just want to highlight a couple of things of the forecast here. It's really measuring in 3 parts: housing measures, interest rates, mortgage originations, and mortgage debt outstanding. I want to focus in on interest rates. So, interest rates here, their predictions there's like 7.3 in 2023, 6.5 average in 2024. They're looking to go down in 2025 to the high fives and kind of maintain that into 2026. So we're looking at interest rates through these predictions somewhere in the 5.5 to high five, mid to high five 30-year fixed rates going forward, which will bring a lot more buyers back into the marketplace from the 7%, 7.5% interest rates going forward. Mm-hmm. So those are positive signs, and they also lean forward to their same prediction of more home sales going forward. That's on new construction, and existing home sales are predicted to go up 20-30% in the next year, and especially into 2026. So it's a good time to be back into the market and to hopefully alleviate some of the inventory issues that we've seen and the high interest rates of getting in.
Perfect. This chart's very nice and easy to read. I like the summary on the right: 23, 24, 25, 26 interest rates. There you go. 7, 3, 6, 5, 5, 9, 5, 9. I love that.
Exactly. It's there. I hope they might be a little conservative. I'm hoping we could see lower. Who knows what could happen in the future. Right. I've got one other one here that just kind of makes it a little easy to track for my brain. It's kind of showing forecast for August of 2024 into the different quarters going into 25, first quarter, second quarter, third quarter, fourth quarter of 2025. And you can see it's following the same trajectory. Interest rates going down. We hope that will bring more people into the market by more of an affordable payment. We're also hoping that maybe we can have some people that are sitting in the 2s and the 3s want to move up because they have a large, significant amount of equity in their home to move into the future. Something in the 5 is a lot different than something in the 7%. So, from where we have been the last couple of years, it's been a painful process to go through with higher interest rates moving up. This shows that there's a bright spot in the future. And it also leads us to what we've been talking about, Elizabeth. Buy the house that you want. Yeah. Do it now. Do it when you can, because nothing's permanent. Yeah. Everything will change in time. So that's really what that is staying out. And more importantly, have a plan in place. Work with somebody that understands this and can make sure that both your short and long-term goals are met.
Yeah, I mean, we just worked with some clients, about a year ago, that purchased, and they've already done a refinance with you.
Absolutely, they did. It worked out perfectly, and it's really matching up. And quite honestly, we're already have a 6-month plan in place now. So
so they've been gaining equity for over a year. They didn't wait, so the house. The price that they got in on their house was lower than it would have been a year later. Now they're down on their interest rate. Now they have another plan, and they're moved in, they're settled, they're done. So when these rates come down and we see a rush of buyers hit the market, they didn't have to go through that because they bought when it was a little bit cooler. So it is a great time to buy when the time is right for you. And depending on where you're buying, if the supply and demand, if there's still an issue with that, there's, no matter what that interest rate is, it's going to be tough to get into some areas. So again, working with a good, experienced realtor to explain all that, dissect that, look at the data, understand what the market is going to need you to do to be successful, and then pairing with a loan officer that can work the financial end and make sure that you are doing everything you can to pay the least amount of money and be successful. So there you go.
That is the plan.
Lee Williams, Brace Homelands. Anything else for today, Lee? I really enjoyed your summary of what to look for in the future. I love the forecast. How can people get in touch with you?
Exactly. I'd love to have these conversations with individuals and really
Yep.
put together a plan in place. So the best way to call me anytime, I'm 24/7, 571-420-3116. And then you can always visit my website at williams1003.com. I look forward to hearing from you. Thank you, Elizabeth.
Thank you, Lee. Yes. So everyone out there, please feel free to reach out to Lee. Any questions you may have about buying in the future, or if you did just buy, possibly refinancing. And, no matter where you are in the country, if you need a good realtor and or lender, feel free to reach out to me. I can connect you with someone in your area. We have a national agent referral network. Happy to do that for you. And again, thank you everyone for joining. Please subscribe. Please like the show and share. Send me some comments. Give me a call, 703-829-LIST. I'd love to chat with you and see what you thought about the show and continue our journey together, educating people who are looking to buy or sell residential real estate. That is all for today. Thank you so much for joining me on the List with Elizabeth show.
When you're ready to